Hello everyone, welcome to Ayurveda Learning Hub. I hope you did like all our previous videos and subscribe to our channel. Now, as promised by me, in this playlist I'll be describing stocks for you. The process of buying stocks, what is stocks, why are they issued, how are they issued, who issues them, how can you gain more and more from stocks, what can be your analysis process for the stocks. I'll tell you everything. Stay focused, stay tuned, like this video, and if you have any doubts about anything, tell me in the comment section. I'll reply back to you. So let's begin. I hope you have subscribed the channel, right, and turn on the notifications. If you didn't, do it now. So beginning, what is stock? A share or a stock is a price or a piece of shared ownership in a business, whether it is a small company or a private group of owners. Okay, it can be a public limited company, it can be a private limited company, it can be a very small organizations, but you own certain amount of the organization, you own certain stocks of the organization. So let's take an example. I'll explain you with the example. Supposedly in Nike, Nike has released 10,000 shares of its, and you own 1,000 shares of Nike. So now you own 10% of Nike. But as I told in one of the previous videos, if you didn't check them out, do go and check it now. It's a very important video. Now, if a company has listed its IPO or its shares, now if you own more than 5% of these shares, the company gets notified. The company gets notified that who is gonna own the major part of the company from now. It's gonna be you. So now if you own 10% of the share, the company knows you are a major owner. Because people own 0.001% of shares, 0.001, it's a lot, it's divided. So now you are a shareholder and you own a lot amount in the company, and the company knows you are holding it. So most people consider stocks as risky, which is true, but if you see if you check out the graph, since 1950s to till now, the stocks have increased. There has been certain lows, but it has always increased. The major thing is increase. So if somebody stores a certain stock for 50 years, 70 years, 30 years, he or she always gains. Even you gain it in a 2-year period or a 1-year period. But if there's day trading. If today the price of the stock is 12 rupees per stock and tomorrow it is 15 rupees per stock, when you sell it next day, you have brought 10 stocks today, you sell it next day, you make a certain gain. But these are small gains. If you want to make large gains, you need to invest for a year, 2 years, 10 years, 5 years. Your period, your investment, you decide that. So most people consider purchasing stock as long-term investment. In simple terms, long-term investments make you gain more. So people consider it as long-term investment, which is a great idea. Now, buying a stock for a smaller price and selling it for a higher price is the easiest way down the road to gain from stocks. This is called capital gain. Very simple. Buy it for a low price, sell it for a higher price. When the demand increases, you gain, and it's called capital gain. Now, second type or another way to make money in stocks is called dividends. Now, companies periodically pay dividends to their stockholders. This is done to encourage people to buy stocks of that particular company. So the company pays you dividends. So this is how it goes. Dividends are periodic payments made to the shareholders based on the proportion of the company's share or the company's profits. Now supposedly Nike gains a lot this time. They gain thousands of crores. So they decide to pay 1,000 crores to its shareholder. And you hold one share. So what will you get? You'll get, it was paying 1,000 crore, or maybe it was just paying 1,000 rupees. You hold one share and there are 1,000 shares. So you gain 1 rupee extra. This is a small example. Companies distribute in large amounts. Per share it usually comes as 250 rupees, 350 rupees, and people gain a lot. Since they hold n number of shares, or some number of shares, at least nobody invests of 1 or 2 shares nowadays. It's all retail investors which do so, people like me and you. But yeah, with time me and you also invest a lot. So now we'll learn about returns from stocks. These were 2 types of returns, capital gains and dividend gains, but I'll be describing it in great detail to you, telling the mathematical formula and everything. So stock investments can increase in value if a company performs well. Yes, the company is performing well, it's expanding, it's gaining, so the stocks expand, the prices increase, and you can easily make capital gains. Now, the idea is to hold on to the stock till they continue to increase in value and sell them when they start decreasing, or you feel that it's the maximum increase the company can achieve. So additionally, the company earns a profit sometimes, and it may choose to pay a proportion of its amount to its shareholders called dividends. Now, the total amount to be paid is divided up equally among all the shareholders and distributed. This amount is called dividend. So the total amount to be paid is divided equally among shareholders. Now, if you hold 1% of shares, you get 1% of the amount decided. You don't get 1% of the profit. You get amount from the profit is decided, and you get 1% from that amount. If you own the 10% of the company, you get 10% from that amount. So supposedly you own 100 shares and the company decided to distribute 2000 rupees as profits, then you would get, there was 100 shares. A company has distributed 100 shares in the market, and it's decided that it will give 2000 rupees to its shareholders, and you own 10 shares. So you will get 20%. Now this is also called as return on investments or rate of investments. So obviously we all invest for returns. So we want to increase ROIs as much as possible. We invest for more and more ROIs. The place where we get more investment, we invest more. The ROI is more. If ROI is less, we prefer not to invest. So the price return tells you how much the stock has increased or decreased in value since you have bought it or purchased it. It's in percentage. So you can see it in your applications, in your web pages, that at what amount you bought it and what's the price now, how much you gained. So if you purchase a stock supposedly for 100 rupees per share and now the price is 110. So when you divide it, you find out that the stock has increased by 10% and you have gained 10% amount. Now similarly, dividend return is a measure of your total dividend earnings since you have purchased the stock as a percentage of original purchase price. So this is also taken as a percentage of original percentage price. So supposedly, let's take an example. You had 10 shares of a company X and you bought it for 100 rupees per share, and you received a quarterly dividend. That means you received dividend 4 times a year, which was 1 rupee per share. The company distributed this way. You got 1 rupee per share. You had 10 shares and you bought each one at 100 rupee per share. So after 1 year, your dividend return calculation would look like 10 into 1 into 4, which means 40 dividends. 10 shares you had, 4 times you received 1 rupee on each. So you received 40 rupees as your dividend value. When you take this out as percentage of your initial, of what amount you bought, so you bought at 10 rupees, 10 shares at 100 rupees per share. So now you have gained 40 rupees. So you have gained 4% dividend on your initial value of investment, right? I hope you get it. How much dividend you got in rupees? 10 into 1 into 4, because your dividend was 1 rupee per financial months. It was given 4 times a year. 1 rupees 4 times a year, which means 4 rupee per share. You had 10 shares, you got 40 rupees initially. And how much you had bought these shares for? You had bought 100 shares for 10 rupees each, which means you had bought it for 1000 rupees. So if you take out percentage for 40 upon 1000 into 100, you gain this time 4% in your dividends. Stay tuned for the further videos. Do hit the like button, and if you have any doubts, do tell me in the comment section. Let's meet in the another video and describe the stocks further. Thank you.